We will go on to the session. Very good morning. Welcome everyone. Thank you for joining us for today's webinar. My name is Kumaran. I am the head of Computer Science and Engineering Department, Jaya Engineering College. On behalf of Jaya Group of Institutions, we welcome you all for the webinar on fundamentals of IT audit. Today we are pleased to welcome our speaker, Ms. MADHURI DURAISWAMY from Ernst and Young's Advisory Services Practice. It's one of the world leading services organization. They provide services to all around the globe. Their main services are assurance, tax advisory, digital strategy, consulting, financial advisory, and legal. The services revenue is approximately US dollar 36.4 billion in 2019. Around 2,70,000 employees working in this organization around the globe. We extend a warm welcome to you, Kala. We are very happy and proud that you are working in one of the world topmost company called EY. Today's webinar provide a kind of knowledge about another discipline in IT industry called IT audit. So an IT audit is the examination and evaluation of an organization IT infrastructure, policies, and operations. IT audit determines whether IT controls protect corporate assets, ensure data integrity, and are aligned with the business overall goal. The IT auditors examine not only physical security control, but also overall business and financial controls that involves information technology system. We are going to hear a lot about on IT audit from the expert. Before getting into the session, I request all the participants to make a note of the following instruction. At the end of the session, I request every participant should submit the feedback form. We will provide the feedback form at the end of the session. You can find the feedback form link on top of the chat box as a sticky note. I request every participants to click on the link and submit the feedback form through which the e-certificate will be generated. You will receive the e-certificate within maximum of 2 days. In feedback form, type your name in the capital letter and you can provide a valid email ID. Check the email ID before submitting the form. We will take care of each and every one of your concern. If you have any issues or any kind of inconvenience, please write to us through mail or through WhatsApp. The second technology used here is purely rely on the strength of the local bandwidth. If you have any audio or video issues, kindly click the reconnect button. The reconnect button can be found on top of the screen. There's a red color labeled called reconnect. So you can use that button for smooth receiving of our video. And if there is any technical issues from our end, we will be back in a maximum of 20 to 30 seconds. So do not leave the room or close the window. So for any reason, if you are closing the window or closing the browser, so again you have to re-register and you have to connect with us for the webinar. So if you have any questions during the presentation, please type them into the chat box and select QA mode so that it's easy for us to identify the question. We will address all your questions at the end. So the recorded version of this webinar will be available in YouTube after 24 hours. So you can watch the replay of videos of all our webinars through YouTube. So with this note, now without further delay, we will turn the time over to the speaker. It's my honor and privilege to introduce Ms. MADHURI DURAISWAMY. Kala is a risk assurance senior manager in Ernst and Young's Advisory Services practice. She has over 11 years of experience in IT risk management and complaints. Kala's experience include internal and external SOX and financial statement audit, third-party service control reporting audits, assessments including assessing data governance, security, and privacy control against established framework. Kala has a Bachelor of Computer Science and Engineering from Anna University and also earned her master's degree in Information System from the University of Florida, USA. Kala is also a certified information system auditor and is currently working to get certified information system security professional. So with this brief introduction, without wasting our time, we will move on to the session. I'm very glad to welcome Ms. MADHURI DURAISWAMY to present. Over to Kala.
Thank you so much, sir. Thanks for that kind introduction. So I'll start presenting my slide here. And welcome to everyone for this session. And this is my first time presenting on this platform. So if there's any technical issues, please let me know on the chat window. I'll turn off my video just to save some bandwidth, but we'll be back on towards the end to answer any Q&A. So the topic here is fundamentals of IT audit. And let me go ahead and share the slides. So I don't want this to be more of a lecture from my end because audit itself could be quite a boring topic. So please feel free to ask questions. Either, like Sir said, maybe towards the end we can have the Q&A and you can just leave your questions in the chat window. But my objective here is to just walk you through some of my day-to-day job, what I do, and what are the basics of audit. Audit is a vast area, and IT audit is also a lot of a lot of technical areas. So I don't want to get into too much technicality, but we're going to cover the basics and talk to you about some concepts of IT audit, and hopefully, if that interests you in pursuing a career, that might be helpful. So to begin with, I'll just walk you through the agenda. I'll talk to you about a career path, my career path, and also a typical career path in the audit world. I'll talk about some of the background, like the basics of what is audit, the role of audit, history of audit, and some key types of audit, and then dive into IT audit in specific and phases of audit, the scoping, the risk controls, and how do you design and test controls, how do you evaluate control deficiencies, and finally, how do you conclude and report on the audit. So the first slide here is about the career path. This is just an illustration of my personal career path. It's also very similar if you think about any of the big four, if you're interested in joining. The big four, which I might keep repeating, is EY, Ernst & Young, where I work. And then you have PwC, PricewaterhouseCoopers, KPMG, and Deloitte. These are the four big audit firms. There are other audit firms as well. So in the big four, this is a typical audit career journey that you can expect. So I personally graduated from Jaya Engineering College, like Kumaran sir had mentioned, with my undergrad in computer science in 2007. And shortly after, I gave my GRE and pursued my master's in University of Florida for information systems. And as soon as I graduated, I ended up with a job at Ernst & Young as a staff auditor in their Tampa office. And so once you become a staff at one of the big four, the progression is typically 2 years of staff, 3 years of senior, 3 years of manager, and then you have senior manager promotion, which is the track I followed as well. So if you see, I got my CSAT certification, I got my manager promotion, and then shortly after, I got my senior manager promotion. But once you make senior manager, it's really up to you how you want your career to shape after that. The typical goal for most of the people would be partner track. That might take you 5 years, 6 years, 7 years, 8 years, just depending on the economy, depending on the need of the business. So that's one of the options, definitely preferred option. The other option and multiple other options and opportunities are working in the industry. You could go as an IT director, or you could work as an IT compliance officer, IT risk management. You could even join the internal audit function in one of the public companies. So there are a lot of different avenues you could pursue once you have a Big Four job. So I just wanted to highlight this in case there are students here who are interested in audit and pursuing a career in audit. All right, so what is audit? I'm sure we've all heard the term at some point, but when we think of audit, especially when I tell my parents what I do for a job, and when I say audit, immediately they think about taxes. And I have to try and explain to them that's not what I do. Taxes is not anywhere close to what I know or what I do for a living. So it could get confusing. So IT audit, that's why I wanted to sort of give this background. Audit in general derived from the Latin term audiere, which means to hear. And we can, in a lot of English words like audible, audio, it kind of came from this same terminology, audior. It kind of reflects the fact that back in those days, in ancient times, audit was still existing, but it was mostly listening to the oral reports. So they were not actually writing anything down. They would listen to someone's accounts, like profits and losses or revenue or whatever, but they would just be orally told, and then they would audit based on those oral conversations. So there was not like actual evidence. But over the years, of course, we have evolved and now we have written records. But that's where it originated from. And the definition, like we already uh, heard from Kumaran sir at the introduction, it's an official inspection of an individual's or organization's accounts. And mostly it's a financial accounts. And it's typically done by an independent body. It's important it's done by an independent body because you don't want any conflict of interest. For example, if I am the person making the transactions, like the financial transactions as part of a company, and I am the one monitoring the transactions, I can't be the same person who comes in and audits the same transactions. That wouldn't make sense. So as an auditor, you shouldn't have any vested interest in the company that you're auditing. So that's called independence, and that's very important. So in general, when we say audit, it refers to a financial statement audit. And we'll go into details about what is financial statement audit in a bit. But one quick fact is auditing origin can be traced as early as 18th century. So audit actually started in the UK. And so I think Italy was the origin. And then it sort of spread to US. And so in the next slide, I think we'll be talking a little bit more about, in a couple of slides, we'll be talking about history of audit, so we can see how it evolved. But it's a quick fun fact that auditing was not something that started in the last 10, 20 years. It's been there since the 18th century. All right. So the role of audit. I think it's important to establish this because we all wonder why, at least my clients always wonder, oh my God, you guys have come back again for another audit. It just feels like we finished one audit and you're here again. And then we always have to tell them audit is a necessary evil. So even though you all hate it, it's absolutely necessary. And this is why it's necessary. Here in the slide, you can see principals, agents, and auditor. So there is something in economics called the principal agent problem. And this is where it originated. So who are principals and who are agents? I can explain this with a little example. I'm sure everybody is under lockdown, or most of us are under lockdown because of COVID. So imagine you can't go to the grocery store and you have to have somebody to go get your groceries, your vegetables and fruits from the market once a week or whatever. So you pay this person how much ever money and you ask them to get your fruits and vegetables and deliver it to you on a weekly basis. Imagine this person goes to the market and there is a big discount going on. It's buy one, get one free or whatever sale is going on. And he or she would buy whatever stuff, and the extra money that they make, they probably will never tell you and they'll pocket it. So that's one scenario. They could also be actually buying you the right stuff and giving it to you, but you may not trust them. That's the other scenario. So there are multiple scenarios here, and there are lots of real life examples where this principal agent problem exists. In the example I just told you, the principal is you who's paying money to someone. So you are the principal. And the agent is that other person who's trying to go to the grocery store and buying the items that you asked for. So you are paying someone to go get something done. So that's exactly the same scenario in a business environment as well, where stockholders, who are known as principals, it could be investors, lenders, whoever is invested and whoever owns the company. So they are the principals. They provide the capital or the funding to start a company. So they will provide the capital and hire an agent, and they make sure the agent can manage the business. And when it comes to agents, these people are the C-suite, the CEO, the CFO, CIO, CMO. These are the C-suite people who run the company, and they actually are accountable to the principal because the principal is the owner. And the agents have to provide assurance to the principal by giving them the financial reports to make sure the principal knows what's happening with the company. However, how much ever the agent shares the information, there is a risk, the information risk to the principal, because the agent may not always tell the truth. So this is why you need a third party, and this is why an agent would hire an auditor, independent auditor, who can come in and gather the evidence independently, and they can give their opinion on the financial statements. And so once they give their opinion, that will reduce the principal's information risk. So that way they don't have to rely only on the agent's information. So this is why we have the whole purpose of audit, and this is where the auditors come into play. So now that we understand what is audit and what is the role of audit, I want to spend a few minutes talking about the history of audit. It's a lot more than what's here in the slide, but I've just kept it very brief. In 1920s and 1970s, somewhere between there, US stock market had crashed in 1929. So even before that, like I said, audit, it always existed, but it was mostly focused in UK. I think it came to US only after the stock market crash, where it formalized in the US. So after the stock market crash, the US Securities and Exchange Commission was created. And that body, the government body, was created solely because they wanted to make sure financial audits are mandatory for all public companies. And shortly after, in 1980s and the 1990s, they also created the Committee of Sponsoring Organizations of the Treadway Commission, very commonly known as COSO. And that's the framework which was like sort of the guiding principle for a lot of companies related to financial reporting, and was mainly formed so that there is no fraud, they could avoid fraudulent financial reporting. However, even with the COSO established, a lot of companies did not follow the framework, and you must have heard about a lot of the accounting scandals. Some of the common ones are WorldCom and Enron. Enron was quite popular in those times, where they did not follow the right framework. They did not have any internal controls, so their financial statements were not accurate, and it was too late by the time we found out. So there was $1 billion, I think it was like $40-50 billion bankruptcy. So after that, it was quite evident that something needed to be done for these public companies, and a stricter sort of rule or framework needs to be created. And that's where in 2002, the Sarbanes-Oxley Act was established. So Sarbanes-Oxley Act was specifically created to make sure companies have internal controls over financial reporting. It's not enough to just have financial reporting over your financial statements, but you need to make sure you have adequate internal controls so that the data that you publish in the financial statements are actually accurate. So that sort of started or formalized what we call right now as the SOX audit, which is a short form of Sarbanes-Oxley. So you'll hear me say SOX quite often in this presentation. SOX or ICFR, interchangeably. ICFR stands for Internal Controls Over Financial Reporting. It's one and the same thing, SOX and ICFR. So in 2002, after SOX, there was also the nonprofit organization of PCAOB, which stands for Public Company Accounting Oversight Board, that was created. And the purpose of PCAOB was to audit the auditors. So for example, if I'm auditing, say, Facebook, for example, I want to make sure, I as an EY, I'm representing the company EY. So if EY is auditing Facebook, somebody needs to make sure EY is doing the right job and they're not missing out the details. They're not favoring Facebook by hiding something. They want to, the government wants to make sure there is transparency and there is accountability. So accountability is the key word here. So the auditors also need to have accountability. And that's where PCAOB comes into play. They come in on a yearly basis. They'll randomly select audits that EY does. I have gotten inspected. Some of my jobs that I've done, the projects, they have gotten inspected. And thankfully, we passed. And it's very important to pass a PCAOB audit because your reputation is at stake. If we fail the audit, then it's almost like a black mark on EY's record. So every big four and every audit firm will want to make sure they pass the audit and there's no quality issue in any of the audit. So that's where the auditors are striving to be good and do a great job at every project, and that's the accountability back to the government. So in 2013, there was an update to both COSO framework and the PCAOB because there was a lot of technology updates. So just to bridge the gap, they had updated their standards and made sure there was more specifics to the approach of internal controls over financial reporting. And 2015 and beyond, I just made a note there because audit is always evolving. It's such a transformative world that we live in. Even with COVID, I feel like a lot of things, the way we do things, the way we work has changed, and we've all found our new normal, if you want to call it. So even in technology world, there's cybersecurity, there's robotics, there's all sorts of automation. So with everything happening, audit is also constantly evolving because audit cannot be the same way we audited back in 2000. So a lot of controls have changed, the way we approach the risk has changed. So I think that's a key point to make sure that future of audit is constantly evolving. All right. So now that we spoke about the history, and I threw in the word SOX and financial statement audit here and there, but I want to bring it back overall and talk about the key types of audit. Of course, if you Google for types of audit, you'll have a ton more results because this is not the only type of audit. But from where I see, from the job that I do, this is how we look at audit, and these are the key types, external and internal. The external audit clearly is like the definition external, it's done by an external party. So like I said earlier, it's important to have an independent party to come and audit your financial statements. So that's exactly what it is. An external audit is an examination that's conducted by an independent accountant or an accounting firm. And this type of audit is commonly done on the financial statement audits. You also have the SOX audit, where with the Sarbanes-Oxley, it has become mandatory for public companies to not only have financial statement audit, but also a SOX audit that will look at the internal controls that the management has put in place. So for most public companies, both the financial statement audit as well as the SOX audit, they're both equally important. So this is where I come in, and this is predominantly where I work on both the financial statement audit and the SOX audit. The other hand, you have internal audit. Internal audit is a team or a department, if you want to call it. It's a department within a business. So any business would have an internal audit team. Depending on the business, if it's a small business or large, the team could vary. It could be like one person handling the entire internal audit, or they could have a big team of internal audit members. So they usually focus on operational audits, financial audits, and other compliance, security-related audits. And internal audit's function is mainly to make sure the business is operating efficiently, and so they'll monitor the efficacy of the process and controls of any business. And they also would report back on any failures. That way, the business can react to it quickly, and they can put in controls to make sure the failure is not creating a big problem. So an internal audit function is really important, especially for a public company. All right, so in the previous slide, I had mentioned financial statement audit and the SOX audit. So I want to quickly highlight the difference between the two. The financial statement audit, as we have been talking about, the purpose is to gain reasonable assurance about whether the financial statement as a whole is free of material misstatement. So there is no fraud or error. And you will note that the word reasonable assurance is highlighted because nobody can give 100% guarantee, and no audit firm will give that guarantee, because if we say it's 100% accurate, that won't be true because there's always a place for human error. So we'll take that into account, and almost 100% of the audit reports will always say reasonable assurance about whether the financial statements is accurate or not. But that's the financial audit. Moving on to SOX audit, the purpose, like we have been talking about, it's the audit of internal controls over financial reporting. So here you express your opinion on just the effectiveness of the company's internal controls. We want to make sure management has those controls, and we give an opinion on just those controls, whether it's effective or not effective. So now that we have a good understanding of the audit, the history and the types of audit, and where we sort of focus on the financial and the SOX audit, I want to move on and talk about high-level phases of the audit. So audit has, if you look at whether it's internal or external, it has pretty basic, the same sort of phase. And this is similar to any project that you would do. So it starts off with planning and scoping. So before you start the audit, you want to understand what's your scope. Because if you think about a company, say Facebook again, they have huge operations, right? So they would have a ton of applications, ton of business processes, controls. So where do you start from? So it's important to understand what's your scope and plan accordingly. Then you would identify risk and controls based on the scope. And then from the assessment phase, you would start designing and operating, you will start testing the design and operating effectiveness of the controls. And then you'll start noticing if you have issues or deficiencies, you'll communicate that back to management, and you'll have a back and forth, which is called the follow-up phase. And then finally, once you finalize your findings, you can issue the audit opinion, which would be the reporting phase. So that's the high level, and then we can break it down and go into each phase now. So starting with scoping. So here in this picture, you see like the green highlights have some questions, and it's broken down into financial and technology layers. So in the financial layer, when you want to scope, you will have to answer these questions basically. How do you know that the way financial transactions are managed does not produce a financial statement which is fictitious, incomplete, or inaccurate? So as long as you answer that question, you'll get to the answer of how to scope your financial audit. And then the next question you have is, okay, the financial transactions, they're always supported by IT application. So for example, you have revenue. Revenue is a significant class of transaction in any company. So how is revenue sort of supported by IT application? Maybe they have SAP as their ERP or Oracle or whatever application. So how is that being supported? What's the infrastructure supporting the financial transactions? Where is that residing? So once you answer that question, then you have the other question of how do you know that that IT application, say SAP, for example, how do you know that it's being managed without any errors, either in the data input or processing of the financial transactions? Because you know SAP is holding all the transactions, but by the time the financial reports are being spit out of SAP, how do you know the data has not been manipulated in between? And then you have the answer question, the last question on the right side. How do you know the critical information produced by the entity is complete and accurate? Okay, there's a report coming out of SAP, but how do you make sure if there is 100 records in the system, you have 100 records in your report? So that's the completeness and the accuracy part of it. So as long as you get to ask these questions and think about it and get the answers, that starts the process of your scoping for audit. And in the next slide, it's the same picture, but the green highlight has been removed. So the questions have been removed. And in the bottom, these are the sort of buckets that you see. So it starts off with significant class of transaction, which I just started off with an example. But there are other significant classes, right? So you have revenue, you have payroll, you have inventory. So these are like standard significant classes of transaction for any business. You can't run a business without revenue or payroll or inventory. So each of these significant class of transaction, once you identify them, would have a what could go wrong. What could go wrong is the WCGW that you see there. And that's essentially another terminology for risk. So when you think about revenue process, there could be multiple things that could go wrong from the time the customer orders something online, and maybe they put in their credit card information and the credit card is not accurate, and so revenue is not recognized. So there could be n number of things that could go wrong in the process, and ultimately revenue is not recognized completely or accurately. So you have to identify all the risk and all the what could go wrong in the process. So first step is identifying your significant class or transaction, what you think is important for the financial statements, and then identifying everything that could go wrong, all the risk in that process. And then you think about controls. What are the controls management is put in place to address those what could go wrong or those risks? So that's how you would scope in your financial audit. And then you move on and you see the IT application that's supporting revenue in our example. And so when you think about the IT application, there are multiple layers to any application, right? So you have your operating system, database, network layer. So we have to think what is important. Is the data residing, is everything important? The way that you'd have to decide by the way the person logs in. So do you have to look at the operating system and network and database, or can you scope out something based on the risk? So those are the questions you would have to ask when it comes to the IT application infrastructure. And then when you move on the IT processes, so for example, SAP, you'd have to think about change, access, and IT operations. Those are the three main IT processes that we work with. So changes, when it comes to changes, how are changes made to SAP? So you'd have to ask each of those questions for the buckets for each process. And I'll talk about those processes in more detail in the next coming slides. But similar to the financial side, you see the IT risk associated with every application. So every process pretty much has IT risk. Change has bunch of IT risk. Access would have a bunch of IT risk. IT operations has a bunch of IT risk. So within those processes, you identify the risk and then you identify controls. So you have IT general controls, that's called ITGC here. So you have to identify those controls that's going to address those risks. So that once you identify your financial controls and your IT controls, that kind of forms your entire scope for the audit. So that's a little bit of the scoping. I'm sure there's a lot of other things involved in scoping, but this is sort of like a high level of where you could start with. And on the right side, you see terminology called IP risk, IPE risk. It stands for information produced by the entity. So what we mean by that is any report coming from the company that we audit. So if I'm auditing changes, SAP changes, and if the company is giving me a list and a report of 100 changes, IPE, basically, that's IPE, the report of change population, that is the IPE. But how do I know that report is complete? So that's the risk with IPE. There are multiple risks associated with IPE. So we would test everything we get from the company. So we'd have to test it for making sure it's complete, it's accurate, it's not manipulated, data has not been manipulated. So we do a bunch of testing around the actual IPE that we get from the company as well. All right, so now moving on to control types. So I think we briefly mentioned this earlier, application controls, IT general controls. So you must have heard of these terminologies. But overall, there are, on the left side, you see the type of control, and on the bottom, you see the objective of control. So when you think about the type of controls, there's manual, there's automated. Manual, as you know, the term stands for, it's manual in nature, where an actual person is doing the control. So think about somebody looking at payroll on a quarterly basis. If a payroll manager is reviewing the payroll of all the employees to make sure it's accurate, that becomes a manual control, manual review control. And then you have the automated control, which is also known as application controls. This is something that's configured or this set up in the system. It's coded in the system or application logic. So the system, again, going back to SAP example, So SAP automatically searches for matching PO before paying invoice. That becomes the application control. So you know that whatever happens, SAP is going to do that. It's automatically going to search for that matching PO because that's how it's being configured. And so when you test application controls, you'll test the system logic, how it's being programmed. So that's a definition of an application control. In between the manual and the application control, you have an in between where it's called IT dependent manual control. So it's not entirely manual and it's not entirely application oriented. So IT dependent manual becomes controls where there is still a manual portion, but it is also system driven. So the system drives the control. So it probably generates a report or system looks at maybe there's half of the control where the system is automatically doing a process, and then the remainder is where the manual review comes into play. So IT dependent manual controls have both the manual and the application component to it. So those are the three buckets. And then at the bottom, you see prevent and detect. So those are the primary objectives of a control. So when you think about the objective of a control, why do you need controls? When going back to the previous slide, I spoke about risk and the controls addressing the risk, right? So that's exactly why you need a control. You need a control to address what could go wrong in your process. If credit card check goes wrong, your company will lose money. So that's a risk you're trying to address. And in order to address address the risk, you need to put in a control. And so in that example of credit card check, you could have the system automatically checking for the valid credit card by checking the expiration or the account name, number. And so that happens in every company where they have a lot of programs doing background checks on the credit card. So that's an application control that you can test and make sure it's a valid credit card. So that is a prevent control, what I just explained, because it's preventing someone from putting in an inaccurate credit card. It won't even process if you put a wrong credit card, right? So that's preventing a failure. That's a prevent control. There's also detect controls where once the failure happens, it will eventually detect it. So for example, going back to the SAP changes, if somebody had put in a wrong change and something wrong was implemented, and it's already put in the system, it's in production, it's running. But 2-3 months later, during a review process, the manager catches it. And he's like, oh, during my review, I caught this change. This was not supposed to be there. So they can go back and see what's the damage done. And they detect it so they can go and look at everything that's affected in SAP because of that change, and they can go back and fix it, hopefully. So detect controls are not perfect, but it's very important that companies have detect controls as well, because if something goes wrong, at least they'll catch it 2 months or 3 months down the line, but they'll catch it and they can fix the damage done. So it's important for companies to have a good set of prevent and detect controls. But as you can tell from the definition, the perfect place where companies should focus on is the prevent automated controls, because that's the sweet spot, because you want controls to be preventative in nature so that you don't even get into trouble to begin with, and you also want it to be automated in nature because humans tend to make mistakes. So it's better to have automated controls and it's better to have prevent controls. Of course, not every company has the bandwidth or the money to invest in all the automation. So you have a mix of controls. So it's fine, but as long as you have a good mix of these controls, it calls for a good IT environment. And then on the right side, I want to point out the IT general controls. These are controls that support the functioning of automated aspects of prevent and detect controls. So the IT general controls, like I had mentioned earlier, they are supporting the IT application. So as long as your application controls and your manual controls, IT dependent manual controls, if they need to run properly, the IT application needs to be functioning properly. So that's where the IT general controls come into play. And you want to make sure those are working properly, and that's basically the functioning of the application. All right, I think I spoke too much about IT general controls that this slide probably doesn't make a lot of sense right now, but IT general controls, like I've been telling you, it's supportive of the application. So you need IT controls to support the IT application to address the risk within an IT application. And it's basically broken down into three main categories: manage change, manage access, manage IT operations, which we had spoken about earlier. We'll dive a little deeper into each of these categories in the next slide. Okay, so common ITGC process. So manage change. So manage change is a very important area when it comes to IT general controls, because changes to an application can make or break the system. So for example, if you have developers having access to production, that could completely mess up the environment for change management. So manage change is all about all the changes and any changes that you make to the IT application or the programs, the underlying software, and any other relevant IT component. So you want to make sure those changes are going through a process and it's appropriate. Manage access, moving on to the security aspect. So this is pretty standard, like security. If you think about security, you want to make sure the right users have access to the system. You have right logon controls, so your password controls. You have security, so only the right privileged users have access to privileged access within the system. And again, you need to have segregation of duties. Just like I said, in the change environment, developers can't have access to production. In security aspect, you don't want to have inappropriate people having access to system administrator role or anything significant in the system. And third, the manage IT operations. So think about any processing related, so backups, job scheduling. So you don't want to lose data. So that's very key when it comes to IT operations. All your financial data needs to be backed up, and if there is programs running, you want to make sure it's running completely without incomplete processing of information. So those are the three main buckets of IT controls. And in this slide, we talk about the risk. So there's a lot of risk. I probably not even mentioned most of them in this slide, but I'm not going to read through this. But a couple of things that I probably already mentioned is the segregation of duties. That's a key risk in all the category. You want to make sure the right people have access to the right information, so that that becomes a big risk in both the manage change and access. And with manage change, one other risk I can think of is if the right changes are not being requested and approved. So anybody can request a change and anybody can approve the change, then that's not going to be a good environment. That could lead to a lot of inappropriate changes being pushed in production. So you need to have a process for actual proper changes being requested and then somebody approving the change before it goes into production. So as you will go through this, you have tons of these risk in the IT processes. So our job now is to identify the risk, and then as part of the audit scoping that we were talking earlier, we would identify the controls that management has put in place. So these are all standard risks. So if I go audit a company, Facebook again, for example, so I want to make sure Facebook has controls for addressing each of these risks. So that's a job when we go and audit a company. All right, so moving on, this slide here talks about design and operating effectiveness. So when you think about so far where we are, we've talked about the scoping, we know the risk in the IT area, we know the company has to put in controls to address those risks. And so how do you then start your assessment? What do you do for the design and operating effectiveness? So we start with design all the time in the audit phase. So we go through what we call as walkthroughs. So walkthroughs is nothing but you sit down with the process owner, the IT process owner or business process owner, depending on the control you're testing, and you would ask all the questions necessary to understand the entire process. So again, going back to SAP change management, you would ask them start to finish, what is the process of somebody initiating a change? What is the process of somebody testing the change? How do you approve the change? Where is it recorded? What sort of ticket is created? How do you know the ticket is closed? Who is going to push the change in production, who has access to production, who has access to development. So all these questions under change management, so that you understand the entire change management process. So that's what's called the walkthrough. So as you ask the questions, you'll gather evidence and you would do your documentation around the design process. So this is basically done, the why should you do the walkthrough is basically to understand the whole process. So you understand if there's any gap or any risk or any issue that has not been addressed. So that's why you have to do the walkthrough and understand the design. And how you do it is what I already answered. We basically sit down with the person in one-on-one is probably preferred, and you look at the evidence on their computer and you ask them, how do you go through this? How can you show me how you do this transaction? So then you get the actual evidence of what that person is trying to do. And finally, when should you do the walkthroughs? Definitely in the beginning. Before you start to test, you should need to have an understanding of the design. So the walkthrough documentation is very important to do it at the very beginning. So now that you have your walkthrough, you understand the process, you know what are the gaps, you know if there's any design issues, then you can move on to testing the operating effectiveness. So operating effectiveness means whether the control is operating, whether it's working for a period of time. So the nature of the nature of this testing would be to inquire with the process owner, inspect the document observation, and then re-performance. So when it comes to the change management example, say the process owner says, okay, this year in the audit period, we had 100 changes. Then you would get the report of the 100 changes, make sure the report is complete and accurate, and then you would do a sample-based testing. That's what I mentioned in the extent. So it's sample-based. You cannot possibly test all the 100 transactions. So every firm has a different sample methodology. At EY, we follow 10%. So in 10%, you would say 10 changes, and you would take evidence of those 10 changes, and then you would make sure each of those changes have gone through the necessary steps for the control. So whatever the control management has established, changes have been requested properly, tested properly, approved properly. So for each of those 10 changes, you would make sure everything is in place in terms of evidence. And then you can either pass the control or fail the control depending on the results. In some cases, there might be a follow-up and there might be additional evidence you need to request for, or you may have to even point to a different control. So for example, segregation of duties. There are companies where they do have developers having access to production, even though that's not appropriate. But there are small companies that have that scenario. So in that case, they point to a mitigating control, say a review of all changes. So even though developers have access to production, they would say, well, our change manager is reviewing all the changes on a monthly basis. So that sort of mitigates the risk because all the changes are getting through a review. So in that case, we won't call it an issue. We'll just point to the mitigating control. Moving on, evaluating exceptions and deficiencies. I guess I sort of touched upon that previously, but when you encounter an exception or a deficiency in a control, you pause the testing and you sort of investigate what's the cause of the exception. So it could be an exception because change was not tested at all, or it could be change was not approved or whatever, but you need to understand the cause of the exception. And is it possible with all the changes? Is it a systemic or is it random? So systematic is because the change system didn't work, the ticketing system didn't work, all your changes are going to get affected. But is it random because one change did not get tested because that person failed to click the button or failed to record their testing evidence? So that's a random incident, right? So you need to understand whether the exception is systematic or random. And if it is systematic, there's definitely a problem in the entire change population. So whatever you test is going to be an exception. So your control becomes automatically ineffective. But if it is a random, isolated situation, then you have to understand what's the reason behind it. And if it's just one random issue, then you can extend your sample size. there's provision to do that. So you extend your sample size, say from 10, you now test 20 changes, and then make sure there are no additional issues. And then if there are issues, then again, you end up with the same conclusion, the control is ineffective. But if you don't have any other issues, then you call the control effective. So, and the last process here is the process category. So change management is a category. So even though there are respective controls within change management, if one control fails, it doesn't automatically make the entire category fail. So I could have change tested control being ineffective, but the entire manage change category, the process category, can still be effective because I have other mitigating controls that I can point to. So that's what the whole evaluation exception process looks like. And finally, when we think about the conclusion reporting, there are a lot of control gaps that come across in the testing. So once you identify the gaps, you sort of have to communicate on a timely manner to the control owners. And once you communicate it, they will think about the remediation. The timeliness is important here because in audit, everything needs to be done before the year end. So the audit, whatever you're testing needs to happen within the year. So if you don't communicate on a timely manner, the control owners won't have enough time to remediate the issue. So timely communication is very important. So once a remediation happens, then you get the additional evidence and you have to have enough time to test the remediated control within the year end. So that's one of the things about remediation needs to happen within the year. And so once all that happens, you can aggregate at the end of it all the open gaps, anything that the company is not addressed at the year end, that kind of becomes your issues list or your findings list, and that forms the basis for your opinion. Just because you have issues in your log does not mean your audit is qualified. Qualified meaning it didn't, something is wrong in the material, there's material misstatement. So, but the point I'm trying to make is there could be a lot of issues on your audit finding list, but your audit could still be unqualified and it could still be an effective audit at the end of the day. It just depends on the nature of the issues and what other mitigating controls you have in place in the overall environment. So that's all about the audit conclusion and reporting. And with that, I think we've come towards the end, and I've put in some useful links here. I mean, there's a ton of information online about audit, IT audit, financial audit, but hopefully this presentation gave you a little bit of an overview if you're not familiar with audit, and maybe it sparked your curiosity to learn more. So please feel free to enter your questions in the chat window, and I'm happy to answer any questions you might have. With that,
thank you.
Yeah, I'll go ahead and turn on my video now.
Yes. So, thank you, Kola. We will go ahead and take some time for questions now. Just a reminder to all participants, please be sure to type your questions into the chat box. It looks like we have few questions. And the first question, why the organization prepare for external audit system rather than their own internal audit setup?
Can you repeat the question, sir?
Why the organizations prepare for external audit system rather than their own internal audit setup?
Okay, that's a great question. In an ideal world, they don't have to prepare for the external audit, because if they're doing everything right, then they don't necessarily need to have a preparation per se. But companies are always sort of scared, or they're sort of preparing last minute for external auditors to come, because their internal audit may not be as strict, or they may not be following a certain protocol. So internal audit, it really is important what kind of internal audit function you have. If they are a very organized, streamlined internal audit function with a lot of experience, they'll make sure you follow the controls and processes in a very regular and strict manner. But if the internal audit function, if it's very relaxed and very laid back, then companies are struggling when the external auditors come and ask questions, because that's the first time they're hearing these questions and they don't know how to answer them. So it's very important the internal audit function drives the business in the right path and make sure the business understands the purpose of audit. Because a lot of my clients, when we go in, they don't even know what they're doing, and uh, they don't understand what is audit. They don't know why we're asking the questions. They just think it's a unnecessary process. So internal audit's job is to make sure the company, the process owners are trained. That way, when external audit comes, it's a very smooth audit and there are no issues.
Another question from Lokesh Kumar. Kindly brief something about the different accreditations on CMM level in an IT audit and how it is important.
CMM is change management. What do they mean by CMM, sir?
So they have a kind of accreditation in industry, right? CM level 1, level 2, and so on. Uh, it's not the change management.
Okay, I'm not familiar about CMMI, but CISA, CISA, CISSP, I don't know if that's what they mean. So those kind of certifications, but change management is the CM that I'm familiar with. I don't know if there's a different CMMI, but Lokesh Kumar, if you want to clarify your question, I can take it as a follow-up.
The next question, there's a question from a student, Nasreen Fatima. She is doing MSc in cyber forensic, and she want to know how to start career in auditing.
That's a good question. The easiest way is to, I mean, it depends on if it's IT audit, then you can follow the path I followed. You can get your bachelor's in computer science. That's very, very helpful if you understand IT layers, technical layers. But there are people who come without the bachelor's in computer science as well. They come in with accounting, they come in with even random degrees. But as long as you have some sort of information systems background or some information systems background, basically, so you could even do like a certification, and as long as you can prove that you are capable of understanding the IT components, you could pick audit as your career. And the important skill set, in my opinion, is communication, because as you move up the ladder, it's not just important. In the beginning, you will be doing a lot of documentation work, but as you move up the ladder, it's going to be a lot of communication. You have to meet with the clients, you meet with the C-suite, the CIO, the CEO. You have to talk about audit findings. You have to literally fight with them sometimes to say, this is why your company is not following the controls, this is why the control is failing. They're not going to like it, but it's almost how you communicate. You have to have that articulation to say, these are the findings, and this is why we think this is an issue. So I think that's where you need to focus. And as long as you can prove that in an interview with any of the big four, I think they'll be happy to hire. They don't as much look at the background anymore. So it's, like I said, it's very evolving. We're in a very transformative age. So the degrees don't matter as much as long as you can sort of prove that you're capable of um, doing the work.
There's another question. What are the impact of audit report in an organization? So when you submit your report, what are the kind of impact normally happen in the specific organization?
Yeah, it's definitely like going back to that principal agent problem that we were talking about. It's a very important document that the agents need to show to the principals that the company is functioning properly. So the principals being the stockholders, investors, they are investing in the company and they are the ones giving the capital to run the company. So if the C-suite, the CIO, CEO, whoever cannot prove they're not able to do the job that they're required to do, and if the financial statements are not proper and the audit opinion is qualified, that brings the big blow to the agents, the C-suite. And so the stockholders will lose their trust. So there'll definitely be a change in the C-suite. But also, if there is material misstatement in the audit report, that also has other significant impact. Um, that the company needs to face because there is material impact in the financial statement. So it's very important that the audit report comes out unqualified without any issues.
Is there any certification is mandatory that need to get into the IT auditor position?
Yeah, so the certification that is mandatory, but not at the beginning, but towards when you want to get into a manager promotion, you need to get your CISA or CISSP or one of the security or uh, I think there's a system as well. So you can get any of those certifications, CISA, CISSP, but as long as you have any one of them, you're qualified to get a manager promotion. So there is no mandatory certification at the beginning when you join the firm. I think a lot of people come in with a CPA, a lot of students, but I didn't have a CPA. So I just got a CISA much later. So that's totally fine. But if you have the time now, then go ahead, get those certifications because it'll save you a lot of time once you join the company.
So it looks like we have covered almost all of our questions. Kala, is there anything else you wanted to cover before you wrap up?
No, sir, I just want to thank you again for the opportunity. I think it's a nice way for us alumni people to come back and give back to the student community. And thank you for all the questions. They were all pretty interesting. And I hope everybody got a little something out of it and break that big bubble of audit. And maybe you got curious, and maybe you want to start a career. So feel free to reach out to me. My contact information is with Kumaran sir, so you can ask him. I'm happy to help you guys in any way I can.
Okay, so it's time to conclude our event. Thank you very much, Kala, for spending your valuable time with us in your busy schedule. Kala Madhuri is the proud alumni of India Engineering College. She has passed out in 2007. I hope everyone enjoyed the session. I hope there are a lot more job prospects in this particular area. You people can have an eye on EY. Kalamadri may help you to get into this. I have seen there were many interesting awards received by EY. EY awarded best place to launch a career, and EY is one among top 50 companies where women want to work, and 100 best companies to work for 100 best places to work for in IT, and one of the 10 best companies for working mothers is another important thing. And quite interesting to know the awards received by Ernst and Young's services. Thank you very much, Kala, for the very informative session. On behalf of JA Group of Institutions and all participants, once again, thank you. At this moment, I place my sincere thanks to our college management. My thanks to our chairman, Professor A. Kanagaraj, our secretary, ma'am, Mrs. K. Vijay Kumari, and our vice chairman, Engineer K. Navaraj, our joint secretary, ma'am, Dr. K. Dina, our principal, Dr. K. Samitrai, and all my colleagues who rendered their support for conducting their webinar series. And great, thank you everyone. We appreciate you being here. We will have a small break for this week. The next event is scheduled on Monday, that's 15th June 2020. I will get back to you with details shortly. Thank you all for your active participation. Expect the same kind of cooperation for the forthcoming week also. I kindly thank all the people who are responsible for success of this kind of webinar series. Thank you again for joining us today, and we will see you next week. Thank you, one and all. Thank you, Paul.
Thank you. Bye.